Hello, everyone, and welcome to Hard Money with Marshall Reddick. Patrick Prunty here, Director of Private Lending, and as always, it is truly great to be with you. Tons of education to get through tonight, and I want to get started quickly as I look to guide you towards the ultimate goal of this session, which is turning you into the next Marshall Reddick hard money or private money lender. As we get started, a little introduction about myself, your host for tonight. I've been with Marshall Reddick for a long time. I'm sort of the senior team member, if you will. I actually started my career as a college intern, which a lot of the folks that work for us have done a similar path. And so I actually started lending money around 2009. And our private lending program, our hard money program, was really born out of the recession that occurred in 2008. Many of us are familiar with. So about 2009-10, got into the hard money scene. And it was on a really small scale, right? Short-term renovation loans or fix and flip loans, if you will. Very small loan amounts, 25 to 75,000. And I had a lot of contacts around the country. Right. Specifically, I had a really well-trusted connection in Ohio, also in Tennessee and in Georgia. And in some of those folks I actually still lend money to today. But that's how it was born. There was so much distressed property, if you will, foreclosures and short sales and things like that. And these connections approached me, who had worked for Marshall Reddick for a good period of time already and had the mechanics and the understanding of real estate. But Marshall Reddick, as many of you know, was never historically in the lending business. This is something that's, of course, today not new. It's more than a decade old, but still a lot of folks don't realize that we have this investment option, this arm of our business. So I spent the last decade learning all of the nuances, becoming a private lending professional, and building the Marshall Reddick programs that we have today, building the team, building the staff, training constantly, the development of our marketplace that I'm going to show tonight. And the conclusion that I've drawn over this last decade or so is that lending is passive. It's very scalable, and it's mostly non-correlated. So it's a little bit different when things happen in the market and exterior factors. A lot of times you're going to get no problems with your loans, right? Your value of the asset that could go up and down isn't really relative to you as the lender, right? Because you're earning a fixed interest rate. So again, mostly non-correlated, and so it's a good diversification strategy. So again, the conclusion that I've drawn here, passive, scalable, and it should be a part of a well-diversified portfolio. And a lot of folks that know myself and Marshall Reddick know that we don't want you to have all your eggs in one basket. So let's move on, and as we get started and continue this educational session, let's really understand what hard money is. It has a negative connotation, if you will. People hear that and they're like, hard money, that's super risky. And that's actually not the case, and it's not necessarily true. So specifically, hard money is asset-based lending. And the term hard comes from the fact that it's secured against hard assets. In the case of Marshall Reddick, and usually is the case, is that's real property, real estate. It's meant for investors, not for primary residents or owner occupants. The lender always requires a down payment. So don't think that there's any such thing as 100% loan to value financing. It just doesn't exist. And in most cases, the lender requires a significant down payment, much higher than, say, a traditional lender. So instead of it looking at it with that negative connotation, look at it much differently. And note, however, that hard money is primarily concerned with the value of the collateral property. That's really, really important to understand. Whereas, and much differently than a traditional lender who's concerned with credit and income of the borrower. And not that credit and income aren't important, they're just not the primary concern for a hard money lender or a private money lender. Specifically, and therefore, the primary basis for making such a loan is the liquidation value at whatever time of that collateral property that secures the loan. So keep that in mind. That's a really good definition of hard money as we move into this session. Also, I get a lot of folks asking the question of what's the difference, is there any, right, between hard and private money? And so I like to kind of discuss that as well. So hard money is really organized. It's arranged by a firm that's in the business. It's formal, it's very mainstream, it's everywhere. And it's not that much different. And in fact, it's very similar to traditional lending with some subtlety differences. Hard money has clearly laid out guidelines on the loans it will and won't make. Whereas on the other hand, private money is unorganized and it comes from friends, family, or someone looking to earn a passive return from making that loan. It's informal and it's negotiated on a case-by-case situation. So interestingly enough, we here at Marshall Reddick, we play a unique role between hard and private money. And the reason for that is that we, Marshall Reddick, we're the organized firm that's in the lending business. We have the established proprietary guidelines, where we allow our clientele to be the actual lender, right? And we give our clients access to our consistent pipeline of approved, non-negotiable deal flow. And we've got plenty of deals to go around. Our marketplace that I'm going to get into it's bustling, it's moving constantly, and there's plenty of deals, right? So if you're interested in getting started, which I hope you are, we'd love to have you. Let's take a quick peek at our agenda so we know that we're on the same page here and what we're going to be discussing. So we're going to get into private lending versus buying notes, or oftentimes referred to as trust deed investing. We'll talk terminology basics and from my perspective, really, when it comes down to lending your own money, what's really important. And we'll talk about the programs that are offered, right? Marshall Reddick guidelines, right? Those organized guidelines. We're definitely going to explore our mortgage marketplace a little bit, which is just so cool. And it's been a really fun experience to build this from the ground up. We've got an internal team of software developers, and there's been so much whiteboard diagramming and based on user feedback and so on as we continue daily to improve this marketplace and the user experience, making it just a great time for everybody, and visibility and transparency and safety and all of those things that you've come accustomed to when you think Marshall Reddick. Risk, safety, and details. Obviously, in undertaking any investment, these are key to understanding. And then, of course, an introduction to the private lending team and why you need to work with the team and the benefits of working with the team. I get asked all the time, however, Pat, is hard money lending safe? What's the risk involved? And so we're going to dive into that, but just know, absolutely, it is safe as long as you keep in mind primary factors that you have to when considering making a loan, because there's a lot of unsafe hard money that's out there, but that's not what you're going to get with Marshall Reddick. We have no desire to have you fund or lend on one deal and have that deal go sideways, right? That's unacceptable, because we want to continue our relationship with you on the long term. We want you to be very comfortable with what we do in our programs and to lend with us over and over until you're done, you're retired, or you have no more need to do so. And that may never happen, right? This might be something you do now and on in through retirement. But no, indeed, absolutely, that the Marshall Reddick Hard Money Program is very safe. Also, let's be clear, right, on what we're actually talking about in this session, right? Because I want to make sure that we're spending good use of time. The investment premise discussing in this session is lending your dollars, right? Directly. You are the lender, and you're lending that money secured against real estate. And in turn, for making that loan or that investment, you're earning interest, and you're doing so at a fixed rate. The question really then becomes is, how does Marshall Reddick allow its clients to lend dollars and to earn interest, right? Because everybody really I talk to, they're all interested. They're just not sure how to get started or where to find deals or how to evaluate them and figure out, as we discussed just there briefly, are they safe, right? The ultimate premise, am I going to get my money back when I lend it? Very important question. So how we do it is direct lending on our mortgage marketplace. Okay, so specifically, we're talking about direct lending tonight. In this case, you as the investor, as the client, you choose the loan. You own the loan. You're named on the document. You earn the interest. Seems simple, right? But no, Marshall Reddick doesn't touch your money. Marshall Reddick doesn't make the choice. Me and the private lending team do not make the choices in the direct lending. You do. We facilitate and we arrange, but ultimately the choice and the responsibility is yours, which is interesting too, because one of the things that you have to remember is that you constantly then have to stay invested, right, when your loan pays off. Now, continuing on, Marshall Reddick's dog in this fight as the arranger, it earns, or we earn, the borrower paid loan fees. And there actually are a couple of lender paid fees that are really more transactional, but the lender doesn't pay points, right? And that's really the largest expense in hard money lending. So again, you're making all the choosing, you're owning the loan, you're on the docs, and you earn 100% of the interest. We don't take a piece of that interest. We earn the borrower paid loan fees, commonly referred to as points. It's one lender on one loan, right? So we're not fractionalizing, there's no crowdfunding, right? So whatever the dollar amount is of the loan, you as that individual lender must have that. We have loans of all shapes and sizes. You know, really the minimum is about 50,000, but once in a while we get a loan amount under 50 that we're comfortable lending against. And but we get up into the millions, right? So the pure average is about 125,000 when we add up all the loan amounts and divide them. But we're not allowing you and some random person to like co-fund or fractionalize that deed of trust and co-funded 50-50. Or even further down the line, we're not allowing 100 people to put $5,000 into the deal and then I'll earn that. That's crowdfunding, right? That's fractionalization. That's not what you're going to get in the direct lending program with Marshall Reddick. It's too messy that way, right? We want you to make the decision, you to get eyes on the collateral asset and decide that that's a good loan for you. You're responsible, as I mentioned, right? In the direct lending, you're making the choice. It's your money in the deal. But Marshall Reddick is always here to help. You must know that. And that's a super big question that I always get as well. It's like, hey, it's a little scary. The property looks good, the loan to values look good, and I'm ready to do it, Pat. I'm ready to do it. But when it boils down to it, it's like I'm parting with those dollars and I'm hoping that I get them back. It's a little bit better than hope, right? There's a lot of analysis that goes into that, but just know if there's a default, it's your dollars that are in the deal. Marshall Reddick, again, is here to help you. Me, my team, the entire Marshall Reddick office, all of our resources around the country, and we only lend in markets where we have a footprint, so we can be very helpful in terms of third parties to help, whether that be contractors and property managers and real estate agents and brokers and CPAs and all that stuff that you come accustomed to Marshall Reddick being involved in. So we absolutely will help. But if there are dollars to be expended, such as attorney's fees, those are paid by you, the direct lender, who's earning 100% of the interest on that investment. The alternative, which we're not going to be speaking about tonight at any length, to direct lending, so we have a couple of options in how you can lend hard money, if you will, with Marshall Reddick. So the alternative to direct lending is the mortgage fund, right? So just know that there is an alternative if you prefer to relinquish the choice on the loan that gets funded and that your dollars specifically fund, right? And you don't want to earn 100% of the interest on a particular loan. There's an alternative. Okay, as we move along here, it's very important to understand the types of loans and who is doing the borrowing, right? So strictly, we lend collateral based. We are primarily concerned with the collateral asset, and we only lend against real estate, right? So that collateral asset is always going to be real property. We specifically and strictly only lend in first lien position, always non-owner occupied, and always performing loans. Now, performing necessarily isn't something to be discussed unless we're talking about a secondary market, but we're going to dive into that a little bit too, as opposed to a primary or an origination. Now, Marshall Reddick fills this niche, right? This space that the traditional lender just can't. And it's not that they can't because it's a subprime or a bad credit program. Marshall Reddick program is in no way subprime or after bad credit folks that can't qualify due to FICO score. And in fact, it's actually the complete opposite of that, right? So the borrowers are sophisticated real estate professionals with a very unique situation that just doesn't fit the guidelines or the timeframes of a more traditional lender. And I personally am a prime example of that real estate professional doing all kinds of deals. And a lot of times I can't get a traditional loan. Now, specifically, why is that? Right? Because I've got fantastic FICO score and credit, right? Never missed any payments, no issues, and a long credit history. I've got solid, easily verifiable, and consistent income. And from my perspective, I think I've got a significant amount of cash in the bank to qualify, right? But the bottom line is that, and there's a number of reasons, but I'm going to give you 4 specific reasons about why I can't qualify, to kind of draw a parallel for you about the type of borrower that borrows money from Marshall Reddick and private hard money lenders like Marshall Reddick. But before I move on, and the types of loans that we make, I've got a web address, a URL there at the bottom, right? So I encourage you to look at that. That's where you'll find our rate cards and the various types of loans that we make, because we make rental type long-term hold loans. We make short-term renovation and bridge loans, and we even make ground up infill new construction loans. But if you really want to dive into like loan to values and interest rates and fees and all of those unique things that I would say consider our proprietary loan guidelines. Remember the organized description of the loans that we will and won't make. You're going to find it in transparent, clear as day form using that web address. Okay, so getting back onto the 4 of many examples as to why someone like myself or can't get a more traditional loan and therefore borrows from Marshall Reddick. Specifically, I already have 10 financed investment properties. This is a big one, right? Fannie Mae has guidelines, and one of those guidelines states that if you have 10 personally financed investment properties, the traditional lender, right, the conforming lender who conforms to the Fannie Mae guidelines can't make a loan to you that would be number 11 or number 12 and so on. And the reason they can't is because then Fannie Mae won't buy that debt. They won't buy that loan from the conforming or more traditional lender. So unless that lender wants to be a portfolio lender and hold that paper over the term, which no traditional lender does, right? They're in the business of originating and selling to Fannie Mae. But so that is one of the 4 specific reasons. The other ones, and we've all heard these, right? A lot of the folks on the call tonight are longtime Marshall Reddick clients. Certainly have some new folks as well, and welcome to you again. But you understand these scenarios about how difficult it becomes to qualify for that financing when you're a great candidate. Okay, so I'm buying an investment property and doing so inside or using my self-directed retirement account, right? That's big. In that case, you need a non-recourse loan, and traditional lenders don't make non-recourse loans, right? So you have to go private, and we do a lot of non-recourse lending for self-directed retirement accounts. I'm buying an investment property and it needs significant renovation, right? And I have the intent to flip this property. Or perhaps you've heard of the BRRRR method, the buy and then fix up and all that jazz, and then refinance with the built-in equity by improving the property and then holding it as a long-term rental. So the traditional lenders, they can't lend on a property that needs significant renovation. So again, no matter what your qualification looks like, you just can't get it done, right? And in those cases, a lot of times those loans have to close very quickly too. And if anybody's gone through the traditional loan process lately, you know how painful it can be from a timing perspective. I mean, I see 45 to 60 days these days for the traditional lender to get their act together and fund that deal. A lot of our renovation loans, I mean, we fund them in 10 to 14 days. And it's by no means any more risky than the loans that the traditional lenders are making. The fourth of these would be I'm buying an investment property and I'm buying so significantly under market value, and I absolutely need to close this loan quickly. And I'm doing that because the seller is either out of touch with the true value of the property or something else, right? The seller could be distressed and they need cash like right away. But in any case, like, you have to close that deal quickly. You don't want it to be out there. Perhaps that they just don't know the value of the property and they're getting a bunch of other offers, right? And if you don't perform, then they're going to desire to sell somebody to somebody else at a higher price. So we get a lot of deals like this where it has to close quickly. And going back to the traditional lender, half the time they can't even take your loan application in 10 days. Where we're doing loan application and underwriting and docs and title insurance and escrow and all of this inside of 10 days from a very fast, very well-oiled machine with a team that's all on the same page and really good software on the back end to help us stay organized. Okay, so closing the loop here, that's me. Hi, guys. On who is borrowing this money. Again, this is sophisticated real estate investors, right? Everyone's seen HGTV. Some of the homes and some of the people on HGTV, they actually borrow money from Marshall Reddick, okay? We also support a number of like we buy houses for cash type companies. Perhaps you've heard of Homevestors, for example. They're one of the larger like franchises around the country of these we buy houses for cash type entities. They don't buy them for cash. All of those groups have a private lending relationship with a group like Marshall Reddick. Me, right? I mentioned that. I am a primary person who has the desire to keep investing, right? And would like to use leverage as opposed to paying cash. And so therefore, I'm one of those real estate professionals and a good example of who's borrowing the money. Marshall Reddick, right? We as a business, we have a turnkey program. So we buy properties distressed, we fix them up, we resell them at market value. So we borrow money in our own program. But also to close this up here is that Marshall Reddick vendors, and we have tons of them around the country, our own contractors that we work with regularly, our own real estate brokers and our own property managers and all these folks around the country who are true professionals in what they do. This is not the weekend warrior. That's not the type of person that's borrowing money from us. And it's certainly not the type of person that we want to lend to. We want to lend to those professionals, those folks that we've got a long running relationship with. And that type of relationship and that lending to those professionals with specific guidelines has kept us out of so much trouble and is one of the main reasons that our default rate historically is so incredibly low. Okay, let's talk private lending versus buying notes. And there's a very specific division amongst the two. And anybody else firms that are out there, most of them you'll find they're more really giving you access, if they do it all, to buying notes or buying trust deeds, if you will, and that's a secondary market. Marshall Reddick does that too. It's just most of our business today is origination business. So specifically, private lending is the origination of a brand new loan. Purchase money, refinance, cash out, refinance, those are all new loans that are being originated. And compare that again to buying notes or trustees, which is an existing loan that's already in play. There's a payment history, and you buy that loan from the existing lender who's collecting the payments, right? And then you just take over the existing payment stream. And this is a benefit for some people too, right? You might end up paying a premium for that loan that you're buying, but you might feel more safe about buying that because maybe it's already got like 18 months worth of payment history, right? And so the borrower's got that much more skin in the game over that 18 months since origination. And there's all shapes and sizes. And the other cool thing to think about here is that you becoming the hard money lender, and if you fund a loan, originate a loan with Marshall Reddick, or you buy one in the secondary market from us that you can on our marketplace, you, if you need to for some reason or have the desire to, could sell your loan again, right? We're just trading the paper. The borrower doesn't even know that that's happening, right? So that's the definition or the differences between the private lending versus the buying notes. So it's a primary versus secondary market situation. Okay, let's get into, from my opinion, of the 4 primary factors. And again, you know, there's certainly a lot of people in this industry and folks that have, you know, been in the business a long time. And, you know, so I'm 18 going on 19 years with Marshall Reddick and more than a decade in the lending. And I really analyzed and underwritten thousands of loans and originated them with my own money, our business money, and of course our direct lending client money. And I do so very regularly. We're funding and originating somewhere in the neighborhood of 50 loans per month on average right now. So I have a good feeling and a good handle on those 4 primary factors to consider, and I want to share them with you. So they specifically are the security, which comes down to the lien position. Ultimately, the collateral asset is huge. The key, probably number 1 in all of this, is going to be loan to value. And then, of course, occupancy, right? And that doesn't mean like, is the property actually need to have like a tenant in there? It's just going to be owner occupied versus non-owner occupied. So let's dive into each. But note, before we move on here, that I haven't even mentioned in the 4 primary factors to consider yield or borrower credit. And it's not that yield is not important, it's not that borrower credit's not important, it's just those aren't the primary factors to consider when trying to decide, am I going to make that loan? Okay, number 1, security and lien position. So junior liens are bad, you have to know that. And what do I mean by a junior lien? I mean any lien that's not in primary or in first lien position. Okay, so I insist you only invest in real estate secured loans, right? There are some websites out there and some firms that allow you to invest in unsecured debt. A little too dicey for me, right? I understand real estate. I understand how to value real estate. And so in the worst case scenario for me or anybody that lends with Marshall Reddick, you are always going to have the collateral asset in the event of default. Further, do yourself a favor and only invest in first lien. There's just not a scalable space to invest in seconds or thirds. I've done it before. It's too risky. The market is just unknown about what it's going to happen. And so do yourself a favor, put yourself in the primary position. You're in control when you're in first lien, right? You cannot lose everything. And if you follow my 4 primary factors, the chances of you losing money in the first place are very, very slim. Okay, as I mentioned, no yield is great enough for me to gamble my hard-earned cash on a junior lien. So when it comes to how I run my program here at Marshall Reddick, you're going to find the same, right? I bring that same conservative level, that nature to this business. And so you're only going to find first lien debt on our mortgage marketplace. With first lien securities, I mentioned, you always have the collateral property. So in the event of default, you can foreclose, which is the legal remedy that you have to recoup and get your loan back, get your money back. Okay, the collateral asset. And this is so cool because I just had this conversation with a client today. And I've got this super fixer up here on the screen here. I don't know where that property is located, right? But I might not want to lend against that. And the idea here is ask yourself this question. And it doesn't matter if this is going to be your first loan that you're going to fund with us. It doesn't matter if it's your 100th. And I've got plenty of clients, which, by the way, if you'd like references, no problem. I'd be happy to link you up with people that have lent money with me for a decade or so that would be happy to tell you about their experience. So getting back to the collateral asset, you must ask yourself every single time, am I okay owning this property, right, for the stated amount of the investment, for the loan amount? And if the answer is yes, well, then you should feel fantastically good about making that loan. Because again, the worst case scenario is that you're going to own that asset. But if the opposite of that and you're not okay owning it, well, then by no means should you be making a loan against that property, right? Because you never know what's going to happen. But remember, in first lien position, right, you're going to always have that collateral property. All right, let's talk loan to value, okay? LTV is key. It's probably the primary of these four to evaluating risk, and very plain and simple, the higher the loan to value, the higher the risk, and generally the higher the yield. And then the lower the LTV, the lower the risk, and generally, again, usually lower yield, right? With risk, there's a reward and so on. Now, this is a clip from our mortgage marketplace that we're going to dive into, but I show it because we are very big on transparency. So on every single mortgage or every single loan that gets available on our marketplace, we're going to show you the actual LTVs. And there are a number of different LTVs to consider. So know that that as a primary factor is always going to be available to you. A good rule of thumb too, don't chase high yield. I hate to say it, but I have so many clients that come in and it's like they only, you know, like their number one criteria in lending is yield, and they want to chase that high yield. If you've got a high risk tolerance, right, because there's no difference, as I mentioned here, the higher risk loans carry the higher yields. So the highest yield you're going to get with Marshall Reddick is going to be in the 12% plus range. 12.5, 12.75, something like that. Not that I think that those loans are risky, there's just inherently more risk because the LTV is higher, right? But you're gonna get over time, and if you continue to do more loans, you will catch a default. You just have to factor that in, right? So I stay away after all my experience from chasing high yield. I'll give up yield and take a lower yield in lieu of a safer loan any day of the week. Because if it sounds too good to be true, it might be. All right, occupancy, okay? Only investing in non-owner occupied properties, okay? If you invest with me in Marshall Reddick, that's all you're going to get, because specifically and strictly, as I discussed, that's all we do, right? It's got to be an investor borrowing that. They can't live there. It can't be their primary residence. Right? And in my opinion, the risk with an owner-occupant lending is exponentially higher. And this is because emotion becomes into the fold. Their kids live there, you know the neighbors, and it's like you get scared and you're more inclined to run away or hide from the lender, and you don't understand the situation. And also because the borrower's ability to service the debt, the monthly payments, is directly tied to their employment. Whether it's not in a non-owner occupied situation, right? It's an investment property. The borrower who you're lending to is renting the property, right? And so we're very specific in our guidelines about the debt service has to fit and be in a very positive cash flow situation. Otherwise, we wouldn't make a loan in that capacity. So in the event of default, again, going back to the owner occupied versus non-owner occupied and why you shouldn't lend to owner occupants is that without a doubt, they are more likely to contest a foreclosure proceeding, which translates into an expensive, lengthy, and risky foreclosure. And risky because the longer that process takes, the more time goes by without you collecting interest and the more opportunities there is for damage to that collateral property. Now, I'm getting a lot of questions from the crowd with regard to the foreclosure process and with regard to the expenses and things like that. I can't get into that tonight. There's just not enough time. But myself or anybody from the team would be happy to schedule a one-on-one with you to go over that into detail. Okay, just know that absolutely, if you get a default, we are going to be here to help you, which includes introducing and having telephone consultations with attorneys and explaining the process to you, right? And it varies by state. Each state has a different foreclosure process. Some are more expensive than others. Some are slower than others, and so on and so forth. So I'm going to leave those questions for more one-on-one time separately so that we can get through the session. Okay, as I mentioned, defaults are part of the business, right? When you lend money with any type of regularity or scale, eventually you're going to catch a default. It's just part of the business. It's not the end of the world, right? And if you end up with a default, you'll have to take action, right? Which means that we have phone calls and we talk to lawyers and we get people involved, but you're going to be fine. You're not going to lose principal, right? And in fact, you might actually gain in a default situation. I've seen it happen many times where it's a renovation loan and the renovation goes sideways and the borrower's out of money and they can't fix the project. And so the lender ultimately takes the project back, who comes in with fresh cash and finishes the renovation and ends up finishing the flip and makes a profit. We were integral, Marshall Reddick, myself and the team, integral in making that happen with our connections, and you came out on the high side. I can't say that'll always be the case, but if you take in the 4 primary factors that I discussed into your consideration when deciding to make a loan, you're going to be just fine. Okay, quickly, performing versus non-performing. A performing loan is when the borrower is in good standing, right? Payments are current, taxes are paid, insurance is in good order, and everything is expected to continue to be right as rain. Right? That's exactly what you want. On the opposite of that, non-performing, the borrower is in or near default. Payments of principal interest are delinquent, right, or close to it, or late constantly. Taxes, insurance maybe are delinquent as well or expected to become delinquent. And so I tell you this because there's lots of opportunities to invest out there. And I have people asking me all the time about buying non-performing debt. Considering these definitions, why would anyone in their right mind want to get involved with a non-performing loan? I certainly do not. I have tried it before. It's a very niche business. It is way too active, right? We're here because we want to learn how to passively invest in hard money through Marshall Reddick. We do not want to be active investors. Okay, there are many other important topics that are outside the scope of this session, this introductory session, like loan docs and title and escrow and property taxes, loan servicing, the foreclosure process, right? These are all very important things, right? And we take them heavily into consideration as part of our program. And I'm more than happy to speak to each of you one-on-one and dive as deep into these as you want. But just know that we do everything that a traditional lender would do, right? We only make secured loans. We always go through escrow. There's always title insurance, right? We'll impound for property taxes or hazard insurance if we have to or need to. We can board you with a third-party loan servicer if you desire to. Right? That's like a property manager for your loan. We can guide you through loss mitigation efforts, which would be foreclosure or deed in lieu if necessary. But again, those details are outside of the scope here. What isn't, and what I love talking about, and we're going to get into next, is how to find loan investments, right? Because everybody's like, this sounds great. let's be hard money lenders, but how do I get access to deals? Bingo, mortgage marketplace. Okay, so understand that this is like a multiple listing service, but it's for loan investments. A lot of us are familiar with what the multiple listing service is as we've bought primary residences or investment properties and so on. And then understand that this marketplace is public, it's live, it's updating in real time, 24 hours a day, 7 days a week, 365 days a year. Someone is working on this marketplace. There's deals coming available, they're constantly moving. This is not the eBay of loan investments. And I bring that up, this is very important, okay? Specifically, when you compare to eBay, where anyone can sell anything, right? Not anyone can come, and this is not an open source and people can just upload garbage onto the website, right? In terms of loans onto our mortgage marketplace, right? Every single loan that becomes available is Marshall Reddick approved. It fits our guidelines. There is an individual, well-trained, well-experienced loan analyst assigned to every loan, okay, that is intimately knowledgeable about that loan and that subject property and that borrower, okay? And so it's very well structured, okay? So understand that when you find something on the marketplace, it's a good loan. It's got the Marshall Reddick stamp of approval. The marketplace is very competitive, but it's not too competitive. It's navigable, okay? But some people do get frustrated, right? They're trying to figure out the lay of the land and they're seeing these loans just fly off the shelf, if you will, right? But that's because they're in high demand, right? It's a really good mix of yield versus risk, and it's very passive, right? You just sit back and collect a check for literally doing nothing. Okay, here's a little peek about what it looks like, and I'm actually going to bring up the website and show you guys and tool around a little bit on how to use it. But specifically, you get there with this URL. We're going to talk about loan status, and then you've got this little pop-up here on the left. Might be hard to read, but I'll show you how to get there. This is the URL that will take you to the definition of our loan statuses. And that's very important. You must read the definition of the loan statuses as you start to figure out how to navigate and figure out the lay of the land on this marketplace. We'll also be talking about the filters and how to navigate, and then we'll also be showing the full details of each loan, which is like that listing page. We talked about how this is an MLS. Like each mortgage has a listing page with loads of data. From my perspective, all the data that you need as an investor, as a lender, to decide if that's a good loan for you to fund or not. Okay, we will be talking about how to get there, how to navigate it, specifically about loan status in some detail, and we'll be talking about some other filters, specifically transaction type and loan purpose, and then we're going to look at a couple of listings as an example. We'll do one longer term hold loan, like a rental loan, and we'll also look at a renovate, a flip loan. Okay, so I am going to bring up the website, and here it is. Okay, now this is the home page, right? And so very simply, right, you just hover over invest and you click on mortgages. That gets you to the mortgage marketplace. Okay, and you've got a listing of deals here. These are loans, and you notice the loan status available. I always start by coming up here, and notice I'm not logged in either. So this is public information, okay? I always come up here and I start by hitting this clear button. And when I do that, I've cleared all of my filters. So I'm now literally looking at Marshall Reddick's entire loan history. And then I start from my entire loan history and I whittle down what it is that I specifically, for my criteria and what I want to look at, like whittle that marketplace down. And I do that here with this more filters button. So I'm going to go and click more filters. Okay, and then you've got just like loads of different filters and criteria here and things that you can do to whittle down that marketplace. Okay, now we talked about the definitions of the loan status. Notice they're right there, right? I gave you the URL before, but if you click on that and open it in a new tab, this is where you'll find that. It's in my author page, my blog page, if you will. And it just quickly defines all of the loan statuses that you'll find, because not all of them are relevant to everybody. Getting back onto the marketplace here, we're going to specifically talk about loan status, which I'm going to show you here. And I'm going to talk about the buckets, right? So here's bucket 1, needs funding. There's bucket 2, pending. There's bucket 3, active, and so on, right? And again, this represents the Marshall Reddick entire loan history, including this number, this corresponding number to the right of each loan status. So very easy and specific right out of the gates. It's like, I'm going to deselect all loan statuses, and then I'm going to select only those in needs for funding, which is available. And then I'm going to go back up here and I'm going to hit done. I've now whittled down my marketplace to only those deals that need funding. These are the loans that are available for you right this second to choose from, okay? These loans won't be available tomorrow. And there'll be new loans that are available tomorrow. Again, it's a very fast-paced, moving website, okay? And then each of these loans, right, which it tells you the investment amount, and remember, you have to have that full dollar amount. It tells you the yield, right? It sees the first lien position, right? It tells you the term and so on. And then ultimately, I'm going to open up 2 of these. I told you we'd dive into them. I'm going to look at this one here in Port St. Joe, Florida. So I can go ahead and click the full details button there. And I open that in a new tab. I'll come back to that. And then I'm also going to look at a longer term loan. I'll look at this one also in Florida and Palm Coast, and I'll open that on a new a detail view. Okay, and so here that one is. And so I'm going to come back to both of those. Now, back on my marketplace again here, before we go dive into those specific listings, I like to give a couple of other examples of how to use and what kind of data is to be found here. So I always come up here again, I hit clear. I'm going to go to filters again, and I'm going to look at my loan status. So a question I get all the time is, what's the default rate, Pat? Well, you can calculate that yourself very, very easily. I come right here, I'm looking only at loan status. I'm going to deselect all. And then down here, there's this completed in default bucket. And so these would represent all of the defaults that Marshall Reddick has had in our private hard money program over the past decade. And so I could easily select all of these loan statuses here. And so it'll sum up my corresponding number. And so all of those added up, that's 44 total. And so then 44 total over my loans that have completed and were paid in full, full principal, full interest, exactly as you want, that's 1637. So 44 over 1637 is what, roughly 2.6%? That's the default rate. So defaults do happen, right? But just know that they happen seldomly, and they happen seldomly for a number of reasons that I've already gone over. It's the history with the borrower. It's the 4 primary things to consider. It's the structured Marshall Reddick guidelines. It's the analysts on the team that are very good at what they do. Okay. Also, you might like to see, I'm going to deselect all my loan statuses again, is like, what does Marshall Reddick's pipeline look like right now? Okay, like how many loans are actually like out and earning interest? So that's simply, I would look to my active bucket here. So if I select funded, extension, right? Sometimes I have to give the borrower a little more time. Loan modification, I don't have any of those. Forbearance, I don't have any of those. And then payoff requested, right? Those are about to pay off. So those all total up to 597, basically 600 loans out right now with an individual lender on them, one-to-one, right? And earning interest and in some state. And even cooler than that, if I come down here, right? People like to understand and ask me all the time is like, how many of those are owned or funded by your mortgage fund versus how many are owned like individually by direct lenders like we're talking about. And so I've got this cool little filter here. So as you can see, if I deselect the mortgage fund, 458. Whereas if I do the opposite of that, the fund's got today 139. So the lion's share of the capital that we're managing, which includes, our pipeline today around 600 loans, which represents, I don't know, somewhere in the neighborhood of 65 to $70 million. the lion's share of it is still with individual direct lending clients like yourself. So plenty of opportunities to go around, and there's many other metrics and things here that you might like to look, but I'm just giving you sort of the lay of the land in terms of how to navigate here. Okay, different than loan status, which I've been focusing on. I'm going to clear my filters again. And in this time, maybe you're more interested in those like buy a loan, those secondary market, the buying of a note, right? And so you'd be able to find that by filtering by transaction type. So you can see historically, Marshall Reddick's done way more originations than buy loans. But this buy a loan transaction situation, this is growing rapidly as our program marches into its like 13th year or whatever year. And so if I'm only interested in looking at buy loans, right? Well, how would I do that? I'm going to deselect originate a loan. And then I'm going to move back up here to loan status, and I'm going to deselect all, and I'm going to see which of those are available. And then of course I click done, and I see I've got 2 buy a loan transactions, which again are loans that are already originated, that are performing, right? We only look at performing loans here. Marshall Reddick's not in the non-performing business, right? And then you'd be able to dive into the full details and decide if this loan amount and this LTV is the right loan for you, considering the term and based on the yield and all of that jazz, okay? I'd also like to take one more opportunity and discuss loan purpose. Right, so some people, they only want to look at longer term, really low loan to value, safe loans. And if I wanted to do that, well, those are my hold loans, right? So I deselect all, I click hold, right? And then I'm going to come back to my loan status, and I'm going to hit deselect all and reselect available and click done. Now I'm only looking at all the long-term loans available at this time. Okay, but there are other things that you might like to look at from time to time, right? So for example, we talked about defaults, and perhaps you want to understand, like, glean some more information about those that were in deed in lieu, right? So if you want to do that, again, we don't take loans off the website, even the deed in lieus or the problems that we had, the defaults that we had. You can go back and look at the deed in lieus, the transactions that went sideways, and sort of like figure out maybe what was wrong with those. We don't take them down. They're going to be up forever, as we believe in transparency. And we want you folks to look at this marketplace and say, here's what Marshall Reddick is doing. Is this the right program for you? Do you want to get involved? Do you want to invest? Okay. We're getting short on time, so I want to move on specifically with regard to one short and one long-term loan. I'm going to start with this long-term loan and know that I've got it collapsed, right? Collapse all gets this. I want you to know, like, this listing, this detail view, right? This listing for this mortgage, this loan, how much detail is here? And I can go ahead and expand all, and then of course all of these sections open. And there's the loan to values, right? And there's the third-party services that we're going to work with, and there's photos of the subject property. By the way, this is a smoking deal. Okay, this is brand new construction. This is a non-recourse loan. The borrower is a self-directed IRA, right? It's a long-term, right? So you got to be okay with a 15-year loan. But look at the loan to value. 27% loan to value. This new construction home is waterfront. The borrower is paying $820,000 for it, and the loan amount he needs is $225,000. This is absolutely as humanly safe as possible, okay? And in fact, I'm going to fund this loan, right? And I'm actually going to, but I'm also going to show you the process, right? Because if you find loans on here that you want to fund, there is a formal process. Find this little green button over here. I go ahead and click that. Oh, I'm not logged in. Now I need to log in. So I'm going to go ahead and do so. Get logged into the Marshall Reddick website. Boom, here I'm in this commitment process. My name's already saved in here because it knows for me if I'm logged in. I can either add a new investing entity, me individually, an LLC, a family trust, whatever vehicle you want to use. I'm going to use, and I'm going to fund this with Marshall Reddick Mortgage Fund. I'm funding 100% of this deal, and I'm going to begin the funding process. Okay, simple as that. So going back to this loan, I said it's a unicorn. we get these opportunities. This is the type of unique situation that I've been describing, right? If you're headed towards retirement and you need fixed income and you're very low risk, think about this compared to a bank CD. You can put 225 in a bank CD, is going to pay anywhere near $19.50 a month. And I think that this is just about as low risk, perhaps lower risk considering what the government's doing half the time. And when you consider that into FDIC insured bank account or a CD like I was discussing. Okay, moving along and getting into that short-term loan, that renovation loan. So I'm gonna start opening up some of these sections, right? So in this one, in the loan details section, this is a purchase money loan. The purpose is to renovate, to fix it. And then they end up wanting to sell. That's their exit strategy. So this is a straight up flip. And we support a lot of flippers around the country who are buying these distressed properties that are fixing them up and that are selling them, right? This is a big yield. And it is because the risk is higher. So evaluating risks and looking at loan to values, here we go. Right, and then specifically I'd like to talk about in this case, loan terms. And people might say, geez, this seems sort of risky, right? Well, the bottom line here is that we're very good at structuring our loans. And so we always have a down payment. So notice that in this case, the loan amount's actually $195 versus down here in the property section, the purchase price of this property is actually $150. So I'm lending more than the purchase price, but not initially, right? My initial release on the loan is $135. So the borrower is putting down 10%, pretty significant down payment. And then these releases, these are all progress based. The borrower must do something. They have to continue to improve the property. And we manage all of that, of course, right? But you're earning interest on the full $195 at 12% from day one, even though you're putting only $135 at risk out of the gates. And then as the property improves in value, right, because it's being fixed up, you periodically release more so that there's always enough borrower skin in the game. Doesn't matter if it's a renovation loan, doesn't matter if it's a right? It's all about that loan to value. It's about that loan structure. And I'm just describing this to go to great lengths to explain to you why lending with Marshall Reddick is safe. All right, I'm going to move on from those. Again, happy to do one-on-ones. So is anybody else on my team with regard to how to navigate this. But I think everyone's got a really good lay of the land. Okay, I'm going to dive back here, and it looks like we did get through all of the things we wanted to discuss. So we're going to wrap up here shortly, but just a little introduction to the private lending team, okay? This is a small but mighty team, okay? These folks have all worked with me for a lengthy period of time. They've all trained under me, right? They are all come from an educated real estate background. Right, these are the folks that are in the trenches every day, speaking to the borrowers, becoming professionals on the project, structuring the loan accordingly, valuing the asset. Again, all under the Marshall Reddick proprietary guidelines. Okay, so reach out to these folks. You need to have a relationship with these folks. If you talk to those references I mentioned, you absolutely would hear from them that the great lengths, the customer service that's provided, right? You need to be able to send a text and get a response. You need to be able to call and get a response. Like that's what we strive to provide here as a private lending team. So I just like to introduce my team to everybody and know that you gotta get involved. Okay, we've got just a couple of minutes to talk about frequently asked questions. And as I do that, one of the questions I want to answer coming from the crowd is with regard to the interest guarantee. You saw that probably back here, okay? And it's right down here in terms, so the interest guarantee, we tell our borrowers that there is a minimum amount of interest that they must pay. They can pay off the loan at any time, but subject to that interest guarantee. So again, in my short-term loan program, this is 3 months worth of interest. So the borrower will pay a minimum of 3 months worth of interest for all of my short-term loans. On my long-term loans that are not months, right? My short-term loans get 12 months or less. My long-term loans could be 5, 10, 15, 30 years, right? In this case, we have a 24-month interest guarantee, right? So this represents the cumulative amount of interest paid over 24 months at the stated terms of this specific loan. So I hope that helps answer what the interest guarantee is. All right, back to the presentation. Why should I invest with Marshall Reddick? What makes your direct lending program safe and desirable? I talked a lot about this, but to summarize, from my perspective, it comes down to transparency, consistency, experience, and customer service. You know what you're going to get with us. We do the same thing over and over again. We show you what we're doing in real time. We give you all of the tools. Marshall Reddick has been in business for more than 40 years. I'm a product of that, going on 20. And it's the customer service, again, that I discussed and how we approach things here overall as a business, but very, very heavily in the private lending team. Separately, what makes it desirable, right, is it really boils down to a great mix of liquidity, right, and safety and yield. I don't think that there is a better mix of those things with other investments out there in terms of the short term, the liquidity, in terms of the double-digit interest, in terms of the safety of the first lien position, in terms of a team that's backing you all the time, right? And it's all about solid loan to values, that first lien, and that individually, internally underwritten and approved by a Marshall Reddick employed analyst. It's these reasons that you should invest with Marshall Reddick. It's these reasons that direct lending is safe and desirable. What are the fees to participate as a direct lender? The lion's share of what we're in it for from a lending firm is the borrower paid fees, the points I talked about, but there is those transactional fees that the lender pays, and that every lender pays these on every loan. They're fixed and they're shown right on every mortgage, right? And so they roll down to a funding fee, $150, right? You wire that in with your investment amount and you wire that to escrow, and then Marshall Reddick collects that $150. And then at the very end of the loan, at payoff, right, there's a release facilitation fee. Because with secured lending, ultimately at the end, when you get paid off and you get your principal back, you have to sign a document. You have to release your lien in the county records so that the next lender can put in their lien, right? And we're swapping it. So that's that process. We have to prepare that documentation and provide you with the shipping label and send it back to the county to be recorded. So you're looking at about $350 per loan to participate in all of the services and all of the customer service that we provide, and so on and so forth, and for access to our deal flow. Another question from the crowd I'm going to jump to, which is specifically, again, the guidelines for Marshall Reddick, and I'd be happy to show that on the screen as well and talk about minimum down payments and so on and so forth. And so you can always find that here, right, under the Borrow tab, under Loan Programs. And when you do that, you get to the different types of loans that I talked about, and you get to, like, each of these have a rate sheet where the meat and potatoes are. So if I click that, it'll open in a new tab, and this would be the specific guidelines, the minimum down payments and all that stuff. These are proprietary, right? These are formulated by me and the principals at Marshall Reddick to determine the types of loans we will and won't make, right? And so this gives you everything. Hope that helps. All right, back on. So we talked about the fees as a direct lender, okay? And then let's also talk about, okay, I'm interested, what's the best way to get started? A cool feature that we're working on that's not available today is gonna be like a drip campaign, like you get with an MLS, right? Where you get like loans as they come available emailed to you, right? We've heard that from our investor feedback and we're working on that. But for right now, the best way to get started is to have a consultation with one of myself or one of my team, right? Let's get to know each other. Let's find out what you're looking for. Are you looking for short-term, long-term, higher risk, lower risk, high yield? What ticks, what makes you tick? How many dollars you have to throw at something like this? And then we will headhunt specifically deals that fit that criteria, and we'll shop them to you individually, one-on-one, to help you kind of get started, at least get your feet wet, do one loan. And I challenge you, try us out. I promise you, you're going to love it. That's the best way to get started today. Lastly, I found a loan. I want to fund it. What's the next step? I mentioned that before, specifically with that fund this loan button on every listing. That's the formal commitment process. Every lender goes through that if they want to take down a loan. There is a disclaimer there, right? It's very simple. It just simply states that this is an investment. You understand there's a risk, right? You're going to pay the fees, the transactional fees that we discussed, and that you understand Marshall Reddick is here to help, okay? But there's also this other button, right? It's this request information. And so if there's some other bit of information that we haven't provided on that mortgage listing that you're looking at, that you desire, that you like, go ahead and click that button. When you do that, the analyst assigned to that loan is going to get an email, and they're going to call you almost immediately, right? They've been trained to do that. So if they don't call you very quickly, right? Oftentimes within 15 minutes, maybe within 60, or if it's on a weekend, maybe the next business day. But don't be shocked if you get a call on Saturday evening, right? And they're going to talk to you, and they're going to answer any questions that you have. Okay, so know that those are like the ways to, when you found a loan, to get to take the next step, the formal next step. So thanks so much again for the time tonight, folks. Really enjoy being here. Always love explaining the situation. Would love to have you as one of our next direct lending clients. I look forward to speaking with you one-on-one. Got my contact information on the screen. We can meet here at the office. We can do Zoom calls, whatever works best for you. But again, I challenge you, right? Try this out, decide if this is the right investment for you, because I guarantee that you're really going to like it, and it's going to be a good investment for your diversified portfolio. So thanks again. Look forward to speaking with you soon. Have a great rest of the day. Bye-bye.